Hey everyone, welcome back to another stock market open. Well, it appears the stock market is like that Grim Reaper meme with the scythe, and it just has to go through every single stock and take 30% off. Trade Desk obviously absolutely got destroyed yesterday post their earnings, which is surprising because it wasn't actually that bad. But then again, it's not really surprising this cycle here. Revenue beat for 93 million versus the 487 mil. Adjusted EPS came in at 33 cents versus 29. However, the Q4 estimate was soft by about 5%. So 5%. You were looking at $610 million of revenue for the fourth quarter. And instead of 610, you got 580. So 580 versus 610. You got a 9% miss? 4.9% miss, stuck down 30%. That is how you know you are in an absolutely illogical market correction. And if you look, a lot of stocks are down. I mean, I don't know, Tesla's giving up like 6% a day. The Tesla's probably down more than 30% at this point since the summer. But folks are now suggesting that after Trade Desk's hit yesterday, and it's a disaster yesterday, quote, stock investors looking for a sign of an economic slowdown are taking it out of the advertising industry, or taking it out on the advertising industry, rather. Trade Desk CEO said the company began seeing a reduction in spending in October as businesses such as the auto and consumer electronics industries pulled back. And the company's warnings were similar to what we heard with Facebook and Meta. And a lot of people see advertising is really sort of like a barometer of what's going on with, are we going to have a recession or not? So Bloomberg Intelligence went on to say, like, is this like a gloomy sign of a recession coming? And it's really interesting because if it's a gloomy sign of a recession coming, if your revenue being up year over year, but then missing guidance by 5% is a recession, it doesn't feel that horrible. Like a part of me is like, look, if you're gonna give me a recession at this point, just give me a juicy recession already. Just like really, just take it from us at this. Just grab it, do it. Give us a real recession. But this is like a clown show at this point, where it's just like, oh yeah, don't you know we're gonna have a recession, and GDP just sits at, like we have here on screen, the Atlanta Fed Real Now GDP indicator. GDP ends up sitting at what we have here, which is 2.1%. Remember, they were spot on the last cycle around, the last month. Yesterday, we had a 4.9% read on GDP. And a lot of folks are looking at that going, oh, the economy's too hot. We're going to have to see rates rise. And then it's like you've got this like weird dementia or whatever, where it's like you forgot what happened in the last quarter. It's like, well, missed guidance by 4.9%. That's it. Sell by 30%. It's illogical, but then again, it's kind of exactly what you're kind of getting, exactly what you bargained for in the stock market. This is the stock market. This is what you get. Not saying it's what you want, but it's what you get. And it's the stock market starting to price in this real fear of recession. That's my belief, is that you have a recession being priced in to stocks. And in order for you to actually want to be exposed to stocks right now, you have to believe it's all fugazi, which you might be looking at it going, oh, it ain't. It's coming, boy. It's coming. We're going to have basically the belief right now is the earnings disaster that foreshadows recession. That's the kind of disaster that people feel we are in right now. And it makes sense. Interpublic and ad agencies were on shaky ground after the pandemic, for example, and now they're getting hit again because of fears that we're going into recession. Omicron, and a lot of the COVID variants really helped boost advertising. Ads actually boosted after us, after the first half. And there was a belief that by the second half, ads were going to be better, not worse. And so maybe that's why there's some frustration that people thought, okay, maybe connected TV was going to be the big thing, and connected TV was going to be resilient to the recession. That's the only other way to look at it, is that maybe there was a thesis that, hey, that's a growing sector, because that's what a Trade Desk, for example, is, right? Connected TV advertising. It's a growing sector. You know what? It'll be resilient to a recession. And nothing is. And this is where I really actually like what Jason from the All In Pod, he mentioned yesterday on Twitter, that we can actually go through these rolling recessions. Here, we'll pull it up. Jason, let me pull it up a sec. I'll just log in really quick and I'll show it to you. So Jason from the All In Pod, he had a good argument, this idea about rolling recessions coming. And it's really a way of saying, hey, every industry is basically going to have its period of time where you get recession here, then you get recession here, then you get recession. And it's to be in contrast with a recession coming all at once. So basically 2 ways to kind of have a recession. Everybody starts laying off at the same time, or you get industries experiencing pain at various different stages or periods. Here it is, rolling recession. Okay, so we're going to throw this up on screen. It's an interesting argument. 3 minutes away from the opening bell. By the way, you've got oil back up to $81 on Brent, 76.68 on WTI. You've got 10-year Treasury back down a little bit again, 4.7 bips, just as you have Michael Hartnett from Bank of America, your Bank of America resident bear, suggesting markets are now becoming greedy, that interest rates should be closer to 4 or 5.5% rather than 4.5%, and any kind of reduction in interest rates is actually just greed. That's what Hartnett says, and it comes along as Michael Wilson, good old Mike Wilson from Morgan Stanley, one of the biggest bears on the street, the bear that capitulated this summer at the peak. It said, I was wrong, big mea culpa, even though had he just waited a few more weeks, the stock market started falling. Goes to show even the bear could be wrong with timing. But anyway, Mike Wilson said this is just all a bear market rally, what we're seeing right now. It's all back to his thesis of the earnings recession, which, quite frankly, that kind of aligns with the idea of a rolling recession. This idea that you have every industry going through their earnings recession. Think about when chips went through their earnings recession. End of 2022, Nvidia was like $120. Now, sure, granted, it was before the whole AI stuff and everything. But again, you had the entire chips industry go through their rolling recession the end of last year. It hasn't really hit advertising yet, so it makes you wonder, is now that time? Jason here says, rolling recession, trademark, watch. 22, we watched the tech recession crush the funding of private startups and destroy valuations of public companies. A year later, we feel like things have bottomed. 2023, we're in the thick of a media and ad recession. Nextdoor, BuzzFeed, Jazzlebull, whatever, all bottoming out. I don't know if I really see Nextdoor as something that's bottoming out or just a dumb idea. But Nextdoor is the most nasty platform. Okay, I shouldn't say that's mean. It's just my opinion. You go in there, it's literally just people complaining. I can't handle it. I can't. No. Anyway, so then he's prognosticating here. Could we get a real commercial real estate recession next year? Could we get a travel and leisure recession in 24? What about a retail recession? And you continue these cycles. It's an interesting idea. I actually think it's worth paying attention to. And then, of course, here is Jimbo, who says, end of the year rally is coming. So, in other words, we are fudged.
We actually needed to cool off. We needed to shake out people who really feel, oh, this was just a bear market rally. They have to go. They can't make it to the promised land. That's typically what happens when you get a real rally. You have a pause like this, shakes people out, and then you start again. And that's what I think is going to happen. I think it's real. Not a bear market rally. It's a real rally.
Let's get the opening bell here and get Friday underway at the big board here. As we said, General Randy George, U.S. Army Chief of Staff, and members of the Armed Forces commemorating Veterans Day.
Okay, that's pretty cool having the armed services up there ringing the bell. It reminds me of back in my day when I rang the bell. Anyway, yeah, look, hey, I love the never-ending optimism of Jimbo. 90% green. This is not a bear market rally. This is the beginning of a real rally. Well, thanks for the optimism, Jim. I too am optimistic, but I am also realistic that, you know, you kind of, in order to make money in the stock market, you have to be able to go through pain. Whether you're a bear and you have to go through pain while you wait for your turn, or you're a bull and you go through pain. The worst thing you could do is flip-flop back and forth because you'll always get freaking screwed. Nobody knows what the hell's going to happen after earnings. We all know that. Every time it feels like, I feel like if you really want to make a bet, earnings is like the worst way to do it because it's such a YOLO. And the implied volatility rips option profits right out of your hands. You're better off selling options. You want to make money, become a seller of options. Hashtag not guaranteed. Okay, so Treasury yield steady as El Marketo opens. Biden and Xi Jinping to meet in San Francisco next week. That'll be interesting. We do want to see softened relations, ideally, between China and the United States. The less tension we have, the better. We should be bringing China in as an ally. We should be bringing China in and holding our enemies as close as possible. The same, honestly, should be true of Russia. I know that sounds crazy, but from a long-term point of view, we should have as productive as relationships as possible, because productive relationships, in my opinion, minimize war. It's unproductive cornering of countries that lead to this, these sort of overreactions in areas, and this things make me nervous. But anyway, so then here we go. We've got Apple back at 184, Nvidia 475. Tesla doesn't know what direction it wants to go today. Trade Desk is actually trading up compared to the 31% it was down in after market hours. It's actually it's only down 15%. Oh my God. Yeah. So, this is an interesting headline. CEO robbed at gun store in San Francisco, CEO robbed at gunpoint in San Francisco, still believes San Francisco can be saved. Oh, well, there are a lot of people making bets on the San Francisco real estate market, thinking, you know what, we'll be able to turn it around. Taiwan Semiconductors, by the way, posted its first monthly sales gain since February. Okay, it has been nearly a year. Okay, it's been like 8 months, but it's been nearly a year for Taiwan Semi to actually post a sales gain. The sucker's up 3% right now. And people are suggesting that the chip market, at least from Taiwan Semiconductor's point of view, will be hitting bottom, quote, very soon. Primary chip maker, obviously, to NVIDIA and Apple. They produce 90% of advanced chips. This is a company I have exposure to as well. And I mean, obviously, the companies that I have exposure to, I'm a big fan that as we... I try to position myself before El Big O rallies. The problem is that things have kind of been getting hit more and more and more here in the last 3 months. But I haven't changed my outlook on my excitement for these companies over the next years, especially Intel. I think you started opening a position here around $29, 29 to 39, $31. I cannot wait until we break that 39-ish level right here on the fibs, and we've been trending very nicely up on Intel. So now that's starting to zoom out enough, that'll start looking like a little bit of a Nike swoosh. Oh, good Lord. Okay, so then we have, let me see here what the suits are saying. That's right, we have the University of Michigan Consumer Sentiment Survey coming out in 25 minutes. Let's see how horrible sentiment is. Remember the misery that was the last economic optimism read that we reviewed just the other day. Not great. Economic optimism as low as it's been in 2008, June and July of 2008. Not a great comparison. Implies we're about to go into Lehman Brothers. But then it's also as low as we saw it at the end of 2011, like November of 2011, which implies we set the bottom. So we'll see what the University of Michigan information shows. Treasury rally. I saw an abrupt turnaround Thursday. That's when we saw the 10-year jump like 15 basis points. And there's a belief that liquidity is going to become more and more of a problem in the Treasury market. One of the worst Treasury auctions that we've seen since 2011 when the S&P downgraded us. The U.S. credit rating, that is. And that's a no bueno. So some people think that the only thing preventing the bond market from absolutely collapsing right now is the reverse repo facility at the Fed. You may have heard about it before. It is basically the COVID money slush fund. That's what I call it. It's the stimulus money slush fund. Notice how it was basically zero before about March. It was March of 2021. Basically zero. And there's very little money in here. Maybe at one point, $150, $200 million over here at some of the spikes between 2014 and 2018. Here comes COVID money printing. Now we're all the way up to about $2.4 billion of extra money cushion. This money, by the way, is able to move into treasuries to buy treasuries. This is often also seen as a representation of some money market funding, since some money market money can basically sit here, collect yield, and then pay it out to money market investors. And as you can see, this line is very rapidly declining on the right side, and the reason for that is the Federal Reserve's Luigi Manchin vacuum cleaner. They are vacuuming up as much money as they can get their hands on, and they're going around, in my opinion, to every little stock, doing that, wow, trying to destroy everything, and vacuuming up as much money as they can find. That's basically what's going on. While at the same time, we now have, quote, warnings highlight ongoing inflation impact on consumer stocks. Warnings on weekend liquor and luxury demand point to a vulnerable consumer base that has sustained high inflation, adding pressure on not just American stocks, but also European stocks. Luxury watches declining. Keurig has warned its flagship brands will see a drop in profit. You've got Gucci warning of a drop in profit. The Financial Times did a piece on Hermes the other day and said they're the only ones who are protected and they're not seeing it plummet. Consumer discretionary data remains one of the most important profit warnings, according to Morgan Stanley, with an enduring influence over decreasing sales estimates on not just European stocks, but also American stocks. With inflation remaining concerned, spending going down, will it hit the travel industry next year? Nobody knows. Nobody knows. Nobody knows uncertainty. So then we do have Affirm. I want to give you a quick note of the scary warning, the scary recessionary warning of Affirm yesterday. You won't believe the scary warnings of Affirm. In case you don't know, speaking of the consumer, Affirm is a consumer stock. Not only is it a consumer stock, by lending people buy now, pay later loans, they, in my opinion, are a little bit of an indicator of what you might expect to see going forward in terms of how well or not well the consumer is capable of functioning. A little bit concerning if you get bad news coming out of a company like Affirm, because again, you want to see that the individual consumers are continuing to buy the deliciousness that is debt. Well, and as of at least yesterday, as we went through the Affirm earnings call, which I'd like to be able to pull up right now, but I might have to go from memory here for a moment. The Affirm's CEO made it pretty clear yesterday. Wow, I am shocked. I misplaced it. I apologize. Wait, is it right here? Nope, that's the 10Q. Loser! Anyway, I'll just have to tell you from memory. Rip. Okay. Well, yesterday in the Affirm earnings call, the company made it pretty clear that they're actually not seeing a macroeconomic slowdown, which was really shocking. I was pretty surprised by that. I was certain we were going to see a slowdown. This is a company, by the way, that saw their sales, their revenue growth up about 28.7% on a gross revenue. They were up 28.7% on network revenue, which is when you're swiping your card, way above inflation. And they were up about 37% on total revenue. And then when you looked at advertising, their advertising spend was actually down. So Affirm was a company that grew revenue while shrinking advertising spend. And then I thought, this is crazy. So I went to the earnings call and I read the earnings call. And the CEO, you know what the CEO's warning is to our economy and our recession? Yeah, we're not seeing a slowdown right now, and we're not really seeing any meaningful increase in delinquencies. I'm like, what? But like, if we're really, like I've always said, the worst stock to own going into a recession is a company that is lending BNPL loans because there's no collateral. Like, just stop making your freaking payment on BNPL and they're not going to come take your stuff. They're just not going to lend to you again in the future. So you lose your job, you go into recession. It's one of the first bills you stop paying. You go into deferral or whatever. But they're like, we're not seeing a recession. There be no signs of recession. I'm blown away. That was in their earnings call yesterday. Fact check it, read it yourself. But I was blown away that Affirm suggested we see no recession. Now, obviously, the stock did very well after that. I mean, it's been down substantially. Let's take a look at how it's doing today, actually. But it was a very, very, I see it's giving back a little bit today. Yesterday it was up like 20%. Today it's down like 6%. But it was very interesting to me because it averaged out to 18% gain yesterday on Affirm. Very interesting to me because it was such a great sign for the consumer that even as we look for that recession, it's just not here yet. And it so reminds me of 2011, where every single freaking month, every bear, because I studied markets daily, but back when I was in high school, back when I became a real estate agent in 2010 through 11, 12, 13, 14, 15, this is all I love doing. And every single month, we're going into recession, and we just weren't. And I'm not saying we're definitely not going to go into recession, but at least every granular piece of data we're looking at in terms of company earnings is saying, yes, earnings recession, where earnings are rolling over compared to growth estimates, but you're just disappointing Wall Street estimates. You're still not indicating a recession. It's bizarre. Apple rallying here throughout the day. Actually, it feels like a lot of things are actually rallying right now. Look at that, 4% on TSM. Let's go. Intel up another 2%. Let's go. Trade Desk not doing so well. Trade Desk trying to balance out around 20%. Whereas Tesla up about 1% here. Yesterday, Tesla got absolutely smashed. Complete destruction on Tesla yesterday, but it'll be back. Oh, wow. Look at AMD, 117. People really lost a lot of faith on AMD. This sucker went down to 93. Look at that almost perfect bounce on the Fibonacci's. I actually think this is kind of a perfect chart to show you what I believe this market is to look like. Here, let me go to the week chart. Yeah, this is so perfect. So here's your week chart. And this shows you the chips bottom right here in October of 2022. Here's your chips bottom. Then you Nike swoosh up. You get euphoric though, so you have to correct back to trend. And the Nike swoosh can continue in trend. Remember, I've always said volatile Nike swoosh. I want you to see the NASDAQ. Look at the NASDAQ, folks. People are like, oh, don't you know there's no Nike swoosh? It's been down for 3 months. Really? Look at our yellow line here. The trend. This trend was a resistance. And as we broke through that resistance, the stock market became euphoric. And now it's returned to trend. We're back to that yellow line. We can pull this out and see it perfectly. So pretty remarkable. But I'm personally not so freaking bearish. Even though it was right to be bearish the last 3 months, I'm like, whatever, man. Give it to us, Grim Reaper. Give it to us, Grim Reaper. Come through every stock. Take 30% off every single stock. Make it cheaper for me to add to it. Thank you very much. Because I ain't selling. I ain't leaving. So we've got University of Michigan coming up in 15 minutes. I'm excited to see that because it'll give us some consumer intel again. And it is really the last bit of data that we're going to get before CPI on the 14th. Today is November 10th, which does mean we are raising the prices on the new Verse Pro courses. Tonight at 11:59 p.m., you'll no longer be able to get them for under $100. All you have to do is go to meetkevin.com. We are also traveling a lot for real estate, whatever we got to do. So if you want to shadow me, you go to meetkevin.com. You could shadow Kevin right here, watch me buy real estate. You could get financial advice from myself and the team. We're releasing most of the financial advice videos and follow-up videos that we're making for folks before Black Friday. And then, of course, the new Verse Pro courses are coming out. How to get paid more at your job, negotiate any deal and win, speak and present with confidence, buy your first house, boost your productivity, profitable side hustle, analyze stocks, sell anything to anyone, nutrition for entrepreneurs, how to retire early, how to never pay taxes in America, how to renovate real estate. All of these as new Verse Pro crash courses. They're just on pre-sale right now, so those will be out in the beginning of December, before Christmas. So anyway, let's take a look at what else the suits have for us today. What are consumer habits telling investors? That is the question of the day. As investors gear up for China's Singles Day, the world's biggest online shopping spree set to draw in around 1 billion participants, global consumer sentiment is a mixed bag. Concerns about rising prices and spending habits abound, especially in European countries, signaling weakness. Yeah, no kidding. A lot of companies with European exposure signaling that weakness. Do remember, China, we should be sending thank you envelopes, little red envelopes of thank you to China, going thank you for exporting deflation to America. That's what they're doing. They are sending deflation to us. They're making it cheaper for us to manufacture. You've got substantially negative PPI, like 2.6% producer price inflation. Consumer prices are negative in China. Deflation for China is not good. It makes it much harder for them to deal with the trash debt that they have. And that's their damn problem. Okay. That is absolutely their problem. But it's a benefit to America. It just means I don't want to pull a Kenny G and start investing in China. Although it could be, you could make the argument that, well, maybe you're at a bottom. Man, I got plenty of bottoms to deal with in America. Anyway, China's deflationary pressures just aren't going away, underscoring the fragility of the economic recovery in 2023, says Bloomberg. All right, we've seen the data that came out Thursday. Morgan Stanley sees China potentially facing a prolonged fight against falling prices in the next few years, writing that Beijing is at the initial stage of a deflationary battle as it transitions from an overextended credit-fueled growth model. You're basically potentially creating another Japan. Weak inflation figures would add to more uncertainty to the nation's growth outlook following unexpected contractions in manufacturing, consumerism. We've got credit data coming out. Expectations are growing for the central bank to provide more liquidity support. They've been very slow to provide stimulus, much slower than people have thought for the Chinese economy. Now, I see a comment here. Mr. Reaching for Reality says, do you see a point to tax loss harvesting? Don't you miss out on appreciation over the month you have to wait? Well, it depends what side of the aisle you're on. Reaching for Reality. See, the bears would tell you if you sell now, you are sitting out on losses over the next month and buy back cheaper next month. So it just depends what side of the aisle you're on, my friend. It just depends, I have a hard time believing that the stock market is going to exactly emulate 2022. I have a hard time believing it is going to look just like last year. It usually doesn't. Like people usually, maybe people sold earlier this year, I don't know, in anticipation of a painful end of the year. Do you actually maybe get, dare you say it, a Santa Claus rally this year? It's been wrong in 21. It's been wrong in 22. It was right in 2020, but it wasn't right in the last 2 years. So is this time really going to be different? Who freaking knows? Who knows? But yeah, I mean, I do believe there'll be some tax loss harvesting. I know every time I say that, people are like, oh, but, my stocks are up, 30 to 80% year to date. Okay, but did you buy those stocks Jan 1? Right? Because unless you dumped all your money into those stocks Jan 1, your year to date don't mean jackass. Year to date's a scam. Okay. Speaking of that, let's see what the Financial Times is saying. Jamie Dimon selling his stock. Front page. Good old Jamie Dimon, Mr. Bank Wedge Deal purchaser, dumping his stock. JP Morgan sitting at 144. The banks, I think, are going to be challenged under the weight of likely higher reserve requirements and substantially more regulatory scrutiny. Do not, by the way, if you don't like regulation, get into financial advice like we do at StackHack. Don't get into stock brokering. Don't get into banking. These are things you don't want to get into if you have a disdain for regulation. It is a very bad idea. But anyway, banking, yeah, I don't know. I mean, banking's done so fantastic, but banking is also extremely complicated. There's so many parts of banks that make their companies very difficult to analyze. One of the challenges you have as well is you have banks that are profiting heavily off higher interest rates. But the question is, what happens when those interest rates start trending down in earnest? Do bank earnings start showing year-over-year declines, start showing missed expectations? Is it possible you could have the chips recession last year, the ad recession, or SaaS recession, or whatever you want to call it this year, and then next year you see a banking recession? Of course, that's going to lead to fears about potentially banking collapses, because that's always what happens. And yes, are smaller banks going to collapse? Of course, just like the Idaho Bank that collapsed because of too many loans to truckers when we went through a freight recession. Remember how we had a period of time going through the freight recession? Yeah, rolling recession seems to be a pretty accurate way to put it. So good job, Jason. I couldn't actually agree more. Let's see what these folks are saying. We're 8 minutes away, by the way, 8 minutes away from consumer sentiment data. Talk here about Wynn. Wynn is down 9% right now. Wynn Resorts. Oh, here comes the travel recession. Let's see what we got. All right. Earnings for Wynn. Wynn is not winning. Oh, that is so lame, Kevin. Anyway, Wynn Resorts, what the hell? Dude, they reported like a massive beat on adjusted EPS. Adjusted EPS coming in at 99 cents versus the estimate of 75 cents. Big beat. Operating revenue comes in at $1.67 billion versus the 159 beat. Then you've got Q3 operating revenue beats massively, $619 million versus 541. What the hell? Why is markets unfairly dock Wynn after second quarter, but we see buying opportunity? Okay. I don't even see a forecast here. Stock falls after Q3. Bro, this is ridiculous. They beat on every metric, and the stock's down 8.5%. I don't even have exposure to Wynn, so I don't really care. But, like, my heart goes out to the people who do own Wynn, because this is, what the hell? That's like BS. Wynn Resorts expects a big Formula One weekend, not dropping room rates. Wynn Macau edges up. Gotta love it when those stocks are edging. Revenue beats, EPS beats, Macau recovery, UAE resort under construction. UAW. Oh, imagine a union resort. Come one, come all, come to our UAW union resort where we will teach you how to pick it. Oh, no, don't say that, Kevin. That's mean. I have to do something productive, like striking. Oh, okay, all right. So, well, there's a headline here that says South Pole CEO steps down. I'm like, I didn't know the South Pole had a CEO. Apparently, South Pole is a company that is the world's top seller of carbon offsets. and its CEO is stepping down following months of allegations that the company overstated its climate impact of the products that it sold. Zurich-based company. Yeah, well, when they're doing climate and carbon offset projects in Zimbabwe, and their company is named South Pole, you should walk into that one. Way sus. I don't know, man. This game's a riot. It's all rigged. It's all rigged. Except for Uber stock, which is apparently an all-time high for the year. Uber stock sitting at $51. This is in apparently as consumers continue to spend money, but we were supposed to be in a recession. One of the things that people say is that you have a lot more drivers driving Uber now because more people need second jobs, which is a sign of a painful economy. But if you have more drivers, prices for rides can come down to the point where you actually end up getting more riders. Because if prices of Lyfts and Ubers come down because there's more availability of workers and more supply for Ubers and Lyfts, then you end up getting more people willing to ride Ubers because you have more competition, which is actually great. It's a good thing. I mean, I've been in too many places where you wait for an Uber and it's like, what? 30 minutes for the Uber to come up? This is ridiculous. That's not obviously true in bigger cities. It's like 1 minute. Sometimes you hit order Uber and it's there before you even want it. It's like, I don't have my shoes on, man. It's stupid. All right. Anyway, so we are now 3 minutes away. 3 minutes away. No, not from another pitch that Meet Kevin's new Bros Pro courses have a big coupon code expiring. Same thing for shadowing. We have 30. Well, how should I word this? Probably 30 to 40 of the next 52 days of the year. We are hunting for real estate all day long. That's what we're doing. Literally 30 to 40 days of the rest of this year. We are hunting for real estate and then going into Jan. So if you want to be part of that, all you have to do is go to meetkevin.com, press the little shadow button, or financial advice, or the new Verse Pro pre-sale, whatever. I'm really proud about our little programming we did here, where if you select more, you actually get the automatic increasing discount. You can also email us to bundle up with the Profit Portal, which just gives you everything, which is kind of cool. Okay, so we are now 2 minutes away. 2 minutes away. Nobody knows 2 minutes like I do. Oh, oh no. University of Michigan sentiment survey expected to come out at 63.7. Current conditions expected to come in at 70.3. Expectations 61. U of M 1 year inflation 4%. 3 to 5 or 5 to 10 year inflation expected to come in at 3%. Sorry, 4% for the 1 year, 3% for the 5 to 10. Let's look at the. Will I be in phonics? Maybe. I'm not telling. I'm not telling where I'm going. It's my secret. So I'm going to pull up the break evens really quick while we do this. Okay, yeah, break evens 5 year forward down at 2.37. That's good. Oh, good. Plummeting 5 year break even as well on the 5 year break even, not the 5 year forward, down at 2.27. That's fantastic. I like to see that. I want to see. I've been saying this all freaking year long. I just want to see the inflation expectations go down and down and down and down, because that means we're not dying. And this chart on the right side going down is good. We want more of that. All right, y'all ready? Here, let's pull up the QQQ. So the second this data comes out, you could see the stock market plummet. Honestly, this is not like such a crazy big catalyst where you really need to be horribly worried. It'd have to be pretty damn different. 10 seconds away. Here we go. U of M survey says, inflation expectations higher. You got 1 year at 4.4, not good. That's like a 10% beat. There goes your red candlestick. 5 to 10 year comes in at 3.2. The sentiment survey comes in way lower than expected at 60.4 versus the 63.7 expected. Current conditions comes in the toilet at 65.7 versus the 70.3 expected. Expectations at 56.9 versus the 61 expected. And then, of course, the consumer inflation gauge hotter. Ugh. Rip. Let's see if they're going to talk about it. But that I don't know if that was really a horrible surprise. These, by the way, are the preliminary numbers for November that missed. Final reads for October at 4.2 on long-run inflation and 3.0 on October October. That's October 5 year, 4.2 on October 1 year. Those rose to 4.4 on the 1 year outlook for November preliminary, and the 3.2 for November 5 year prelim. The market kind of shrugged that off. Like, let's go find out where that Grim Reaper went. Interest rate sensitive? Well, they were falling. Let's look at another interest rate sensitive. No, actually, the market mostly shrugged that off. Yeah, you got a couple red candlesticks there, but honestly, I think that's not a surprise. The question is that going to lead to the market selling off the rest of the day? Who knows? I guess we'll find out. Yes. Okay, so markets lower for longer. Damn you, Brian. Stop saying the truth. Honestly, that's actually a great line if you think about it. If you think that is a fantastic line. Because if you think about it, I think everybody thought this recovery was going to go a lot faster. And in fairness, we had a beautiful, delicious first 6 months. And now it's kind of like, what is this? But that's a good one. I like that. That's a good one. Has to complete the right shoulder of the inverse head and shoulders on the SPY. Oh, stop it, you bear. No. Wrong. We are not going down to the 200 SMA. I refuse to let the SPY go down to the 200. That'd be down to here. You'd have to get somewhere on neckline. Maybe it'd be, well, it's probably right here. That's probably about 370. The 200 SMA is about 384. No. Where's my sell button? Do I have a sell button?
Gained the lead.
No.
Lost the lead.
That one.
Betrayal.
Yes.
Lost the lead. Betrayal.
That will not happen. Okay, what? Nvidia is looking cheap to some? Oh my gosh, who's smoking crack today? Oh wait, I kind of agree with that. Oh, but people already believe that anyway. Oh my gosh, yes. Dude, we need a soundboard that. Shut the door. 31095. Don't be jelly. If you're a course member, you get to become a moderator. So then you turn blue chat. And then you're automatically not in poverty chat. You join any of those courses, you graduate from poverty chat. Nvidia bulls are starting to throw around an adjacently. Wait, why did I read that wrong? An adjective rarely used for a stock that's more than tripled in the last year. Oh, an adjective, like the grammar word. Oh, cheap. Okay. Oh, wow. My mindset was not in grammar. That's the view investors like Alec Young, spelled with a C. I guess that'd be the right way. Remember, folks, I will always stand behind Alec Baldwin. Chief investment strategist at Map Signals, who have watched Nvidia shares trade in the $100 range since the summer, are meandering after are now around $500, but with profit estimates still rising, Nvidia's price relative to its expected earnings has actually fallen relative to the lowest expectations since mid-22. The stock is actually very cheap, adding that its price to earnings ratio is less than the company's estimated growth rate, which is uncommon. I don't think so. Maybe maybe they have some fancy estimates, but that's certainly not the consensus. Oh man. There we go. Okay, let's find out what the current consensus is. What's funny is people always get mad at me and they leave me angry comments. You're like, how dare you call me poverty chat? Well, if I pay $5 a month, and I won't. And we were like, I'll be damned if I pay you money after insulting me. I go, man, if you're insulted by that, you just got bigger insecurities. So, okay, Jan 2024, 1088. And then we're looking at growth of Wall Street consensus 57.8%, 19%, minus 5.8. I don't know how they come up with this. I just like to compare the consensus. 88.1 divided by 4 puts us at 22% average growth expected. Stocks currently, yeah, dude, what are you smoking? Stocks currently trading at 43 times. It's not a bad valuation though, based if that growth sustains. Problem with this formula is if the growth doesn't sustain, you're screwed. Yeah, it's at 1.96 on a PEG ratio basis. That's not bad. Like, let's see what Tesla's trading for right now. Tesla right now, you're looking at 213 divided by 3.14. Oh, the earnings are pi. Okay. Oh, the earnings estimates have been cut so much. It's trading for 67 times right now. And growth is expected to be Wall Street consensus pretty low actually right now. Growth is, what's that? 26%? 27.5. 67 divided by 27.5. That puts them at about a 2.4 peg. I personally think Tesla's more likely to grow at about a 35% clip. So that puts you at about a 1.9, which is basically the same level as NVIDIA. Just depends whose peg you believe. The big peg or the small peg. Oh, stop, Kevin, stop. All right, I'm about to go look at my little twins. So, they're so cute. Okay, now we have Enphase expected to come up with... Dude, Enphase expects to have higher earnings than Tesla for the end of the year. $4.40 per share. $4.40 per share. If this isn't a correction, I don't know what is. But Enphase is selling for 17x, 17 times PE. It's so low. Okay, growth expected to be negative 12 in consensus, plus 53.1, plus 5.1, plus 9.7. EPS is expected to be 55.7 over the next 4 years. Divide that out. We're looking at 14 divided by 14. Trading for about a 1.2 peg with reduced growth expectations. Rip. So anyway, let's see how the Qs are doing here. Whale, looks like you got a little bit of a decline there after the sentiment survey. Looks like that might already be trying to get through its little bottoming process there. Hey, Tesla's still green for about the next minute.
Lost the lead.
Oh, I shouldn't have said anything. Oh. With that said, if you want to go check out those delicious courses with a price increase coming later today, make sure to go to meetkevin.com. You could shadow us as well as we go ham buying real estate and look at our renovations as well. And even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized financial or real estate advice for you. None of the information shall be deemed reasonably sufficient information for the purpose of evaluating security. Information is not endorsed by me. Run an actively managed ETF, hold long positions in various positions mentioned here, including those mentioned. Oh, yeah. And I have no relationship to issuers. I didn't read that fast enough. Restart it. I'm also not presently acting as a market maker. None of this personalized financial advice is not tax, legal, or otherwise advice tailored to you. The video provides generalized perspective and information. Commentary. There we go.
Gain the lead.
That's what we're going to be saying later. Oh, I really ruined the ending video.